Hi, my name's Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based insights to help you master the game of building wealth. And I've got a bit of a different one for you this week. It's a potential financing structure that you could utilize to help you still invest in established property and also encourage you not to compromise on the quality of the underlying asset, which is something that I've spent a lot of time talking about on this podcast and in my books, but still also helping you navigate the fact that negative gearing is quarantined and carried forward so you don't get the immediate negative gearing benefit that you would have otherwise enjoyed before budget night. Now, before I get into it, I just want to point out that it's really important that you understand we're staunchly asset class agnostic in this podcast. So this is not an attempt to find a way to justify investing in established residential property. And the reality is on a like-for-like basis, if we assume we're borrowing the same amount to invest in shares versus investing in established residential property, there is no doubt that borrowing to invest in shares wins by a huge margin on a wealth accumulation, tax and cash flow perspective because, of course, borrowing to invest in shares retains the immediate negative gearing benefit. But having said that, I acknowledge that some people have a very strong preference for investing in residential property, and this could be for several reasons. Maybe they're uncomfortable with share market volatility. Maybe they're unwilling to borrow as much as they are to invest in property as they would to invest in shares. Or maybe they see investing in property as part of a longer term strategy that is goals driven, to either get them into the property market, help them upgrade into property, into a home in the future, these sorts of preferences. And as you know, over the last couple of weeks, I've interrogated, how the taxation changes impact people that have a preference to invest in established residential property. So in episode 420, I talked about the 6 levers that you could pull, higher rental yield, less borrowings, buying a new dwelling, small scale property development, these sorts of things. And last week in episode 422, I talked about a bit of mean reversion, the 20-year growth cycle in Melbourne, and what impact investing just before a growth cycle could have on your medium-term returns for the next 10 years, but also on your long-term returns, say, over the next 30 years as well. And so I think today's podcast kind of builds on that. So there's really 3 elements then that we've been looking at. In episode 420, we talked about higher rental yield, somewhere between 5 to 5.5%, gets you pretty close to a similar internal rate of return when you enjoyed negative gearing. In episode 422, I talked about investing before a growth cycle gets you a higher than average capital growth rate, or should statistically, based on past performance, and that also helps you recover your internal rate of return to a pre-budget level. And this is the final element, I guess, in terms of practically helping you manage cash flow as a result of investing in established property. Okay, just to recap, what we're trying to combat here is that, of course, you know by now that quarantining negative gearing significantly increases the out-of-pocket expenses to hold an established property. So using a very simple example, if we invest in a property that generates, say, $20,000 of income after all direct expenses, but our loan interest in respect to what we borrowed to buy that property was, say, $50,000 a year, then of course we've got a $30,000 a year cash shortfall. Now, previously we could offset that $30,000 against other income such as salary and wage, and that might generate $12,000 to $14,000 of a tax benefit, often referred to as a negative gearing benefit, and that would have reduced the after-tax holding costs to around $16,000 to $18,000 a year, so more affordable than the $30,000. The whole point now, though, is if we have to contribute an extra $12,000 to $14,000 to hold the property, we're not going to get any more capital growth in return, and so that compresses the internal rate of return, and it really means that you've got to put in more cash, more of your own cash, to produce the same level of capital growth or generate the same wealth. And as a result, investing in established property is less attractive from that perspective. And it's true that you either might not be able to afford, $30,000 worth of holding costs, or your preference might not be to allocate as much cash flow. You might prefer to allocate some of your cash flow towards additional super contributions, home loan repayments, investing in the share market, and you might have $30,000. You don't want to put it all into one asset. You want to spread it across various assets. That decision is a lot more difficult now, given you don't get the immediate benefit of negative gearing. So one strategy that investors might consider in order to invest in established property and make it more affordable from a holding cost perspective, and also improve the internal rate of return, is to borrow the negative gearing benefit that they otherwise would have enjoyed. So using that basic example that I gave you, pre-budget, the property's holding costs might have been $18,000 a year, for instance, because you got a $12,000 income tax benefit or negative gearing benefit. Well, moving forward, post buying property, post budget night, maybe instead of funding the $30,000 shortfall, which is your actual shortfall now, you put in the $18,000 from your own cash flow and you borrow the $12,000. So in effect, you're borrowing the tax benefit that you no longer receive upfront and repay that debt when that tax benefit is eventually realized, either when the property turns positive cash flow or when the property is sold. And the objective of this strategy is really to align cash flow with the timing of the tax deduction, rather than forcing the investor to fund the entire cash flow shortfall before receiving the associated tax benefit. The other benefit of this structure, which is important and perhaps probably the most attractive benefit of this structure, is it allows investors to focus on quality without getting distracted by rental yield. So in the absence of this structure, it might be tempting for investors to gravitate towards high yielding properties in order to minimize the cash flow contribution and maximize the internal rate of return. But doing so will likely, in many situations, compromise on the quality of the underlying asset, because quite often properties that offer higher rental yields tend to be in impaired locations, say regional towns, outer skirts of CBD, these sorts of things. And as a result, what you gain on rental yield, you probably lose on long-term capital growth, which is not ideal. And what we really want investors to do is focus solely on asset quality when selecting the property, because you're never going to be able to change the location of that asset. And then post-acquisition, then start thinking about all the things that they could do to maximize the rental yield or optimize the rental yield. Now, before we jump into the numbers, because as you know, I always like to delve into the numbers to interrogate whether a strategy like this is actually going to be, going to improve an investor's overall situation. I want to recognize that focusing on just the internal rate of return can lead to incorrect conclusions. See, the internal rate of return measures an investment's annualized return after taking into account the timing of the cash flow or capital that you've contributed to that asset and the proceeds, the return that you end up receiving. So in property, it's really measuring, okay, if I'm going to fund these holding costs of a property over the next 20 years, 30 years, whatever it might be, and then I sell the property and pay capital gains tax, I'm going to get a big lump of cash in my bank account. So therefore, what is the internal rate of return, the annualized return that I've essentially generated on an after-tax basis from making or contributing those holding costs on an annual basis? And internal rate of return is a great way to compare investment options, and that's really how it's used. So I can then think about what's the internal rate of return I can get if I put my capital into a property, into super, into repaying my home loan, these sorts of things. However, the dollar value of wealth accumulated is also important to consider. And ultimately, that's the thing that's going to fund retirement. That's the thing that's going to give us financial freedom and security and so forth. We fund retirement from dollars, not percentages. So, for example, if I could choose between only one investment option, one that delivered a 8% internal rate of return and accumulated $3 million of net worth, versus one that returned 12% internal rate of return, but only accumulated $1 million, of course, I'd go for the one that accumulated $3 million, right? Because you got 3 times more wealth, even though the internal rate of return is lower. So therefore, when analyzing these sorts of things, you need to consider both internal rate of return and the dollar value of wealth accumulated. So with that framework in mind, let's talk about how the numbers stack up. But before we do that, I just want to make it really clear, because I don't want people to think I'm sitting here trying to justify reasons to invest in property. So I want to make 2 things clear. Firstly, there's nothing that I can think about that is going to completely replicate the outcomes that could have been achieved before budget night. There's no doubt that the quarantining of negative gearing and essential increasing in the effective rate of capital gains tax makes borrowing to invest in established property less attractive than it was pre-budget night. Secondly, on a like-for-like basis, investing in established property or borrowing to invest in established property will be almost always inferior to borrowing to invest in shares, simply, as I said previously, because shares retains the negative gearing benefit that you enjoy immediately. But as I said, there's going to be reasons that are specific to individual investors why they might have a stronger preference for borrowing to invest in property rather than shares. So anyway, back to the numbers. I've got a chart on the website. It's a bit difficult to go through numbers and charts in a podcast format, of course. So I'll just give you the highlights. But what I'd say is if you're interested, go and have a look at the chart, because then graphically it demonstrates it a little bit clearer. So the borrowing strategy that I've outlined increases the internal rate of return from about 8.5% to about 9%. So it's not huge, but it's reasonable, and it's getting closer to double-digit after-tax internal rate of return, which is pretty attractive. I think a 9% internal rate of return, it's probably unrealistic to expect something materially more than that if you put your money into super, and it's probably kind of in line-ish with making extra home loan repayments, because of course on a risk adjusted basis, because if I make extra home loan repayments, maybe I'm saving 6% in interest over the long term. If I'm investing in property, I need to earn more than 6% on an after-tax basis, because I've got to be compensated for the risk. If I'm getting 9, it starts to look attractive on a comparative basis. Of course, if we're looking at shares, investing in shares outside super, there's no contest. Investing in shares is probably going to give you somewhere around a 12-ish% after-tax internal rate of return, so materially higher than property. But I've already said that. In fact, I've said it 3 times in this podcast already, so maybe I don't need to do it to death. However, on a actual wealth accumulated basis, if we implemented this structure and held the property for 30 years, it accumulates less wealth. And that makes sense, right? The internal rate of return is higher because I'm contributing less of my own money and I'm still getting the same capital growth in return. So we can understand why the internal rate of return is higher. But we also can understand why it generates less wealth, because if I'm borrowing more, then I'm eating into my equity as a result of doing that. And I'm also going to end up paying interest on interest. So by my calculations, it generates about 15% less wealth over a 30-year period, approximately $210,000 in today's dollars. So to give you an example, if I invested in property and paid all the holding costs, it's going to generate about $1.4 million of wealth. If I use this strategy, it's going to generate $1.2 million of wealth. That's in today's dollars, by the way. So you got a $200,000 differential. It's still pretty reasonable. I mean, it's a reasonable differential, but it still generates a reasonable amount of equity or wealth. And just for context, if I invest in property before budget night, it would probably generate about $1.5 million of wealth. But I would have had to put in a lot less cash flow because I got the negative gearing benefit. So it just gives you some context for sort of making those comparisons. And finally, if I invest in shares, it's about $2 million. So that's what I'm saying. Shares is always going to win, but not everyone's going to want to, invest $1 million into the share market using borrowed funds tomorrow either, are they? So interestingly, the loan to value ratio doesn't really materially change. So it's within 0 to 10%. So instead of having a 30% LVR in, well, I'm just using this as an example, in 25 years, you might have a 35 or 37% loan to value ratio. So I guess what I'm saying is, even though we're borrowing some of the holding costs on a straight line basis, and we know markets never move on a straight line basis, it doesn't materially change the equity that we accumulate in that property. Now, in these projections, I've used a 3% gross rental income yield and 6.5% capital growth rate. I've used exactly the same assumptions when comparing shares as well, although with shares, because it has higher volatility, that's a 9.5% return. I might not assume a 9.5% return just to accommodate the volatility that shares have and the sequencing risk associated with it. But in this circumstance, I wanted to do a like-for-like comparison, so it was important for me to assume the same returns there. So why might someone be attracted to a cash flow strategy like this? Well, as I said, there might be a preference for property either because it's goals-based or because you're uncomfortable with investing in the share market, or at least borrowing to that extent to invest in the share market. And so you might use this cash flow strategy initially to get into the property market. And, of course, those first years of ownership are the most expensive from a cash flow perspective. Over time, the interest rates might change, interest rates might come down. Inflation really eats away at the value of the loan and the cost of the loan. So 6% on $1 million is a lot of money today. 6% on $1 million in 20 years' time, because of the impact of inflation, is a lot less than what it is today. And so you might just use it for the first 3 years, 5 years. I've done my numbers assuming you use the strategy for the entire 30 ownership period, which I think it's conservative, like it's the most aggressive way to use it, but I think it's not the most practical. I think in many situations, a person's going to commit to, contributing a certain amount of cash flow, maybe borrowing some of the holding costs in terms of, the amount that was equivalent to the negative gearing benefit, but not necessarily doing it for the full 30-year ownership period. It also might be attractive to people that believe or expect that at least there's some sort of probability of negative gearing being reinstated in the future. It's something that I spoke about in yesterday's Q&A podcast in terms of, 75% of voters are 35 years and older, and they're not going to like the fact that the value of their assets and property are declining. Notwithstanding, you're starting to see articles in the newspaper talking about how rents are increasing and how renters are struggling as a result, how rental supply is really challenging. The vacancy rates in many of the Australians' capital cities are below 1%. That's challenging for renters. So you start to see all this negativity around the consequences of these tax settings, but none of the positivity. Like, it's actually not generating anything for anyone. All it's doing is making people poorer, both renters and homeowners. And so if you share that view, you might go, well, let's get into the property market before negative gearing is reinstated, because if it is reinstated down the track, we probably will see a significant uptick. It's what we saw between 85 and 87 when negative gearing was quarantined back then. We saw the market really kick off when it was reinstated. And so then if negative gearing is reinstated, let's say in 2028, you might turn this cash flow strategy off. Now, there's two important preconditions that you need for this strategy to work from a borrowing capacity perspective. The first one is you need sufficient equity in property to establish a large enough separate facility for the funding of these holding costs for the negative gearing benefit. The larger the facility you have, the less risky it is, depending on your situation. Depending on your situation, you might not need a huge facility, but I think as a general rule, it would make sense to have somewhere between, say, $100,000 to $200,000 of ready access to equity to be able to use to fund these costs. But the more the better. So the more access you have to unused loan facilities, and it's something like we talk about, I've spoken about many times in terms of locking in access to equity, even if you have no plans to use it. It just limits or allows you to manage your risk, and also keeps you ready in case there are future investment opportunities that you want to explore and your borrowing capacity situation changes in the future. Lock that equity in now. So that's the first thing, is we want to have that equity in property. The second thing that must be present is you've got to have the discipline to use it as intended. So, for instance, if you contemplate an investment, going back to the example that I used and said, okay, I'm going to contribute $18,000, and you start off that way, you want to have the discipline to stick to it. And instead, if you're then going to borrow the full holding costs so that you can spend that $18,000 on a family holiday, that's not how it should be used. In fact, that's misusing it. And of course, that's going to give rise to an inferior outcome financially. So really, you need to have very disciplined and good cash flow management. The final thing you want to think about is your investment temperament. So, of course, we all know that property doesn't move in a straight line. We're getting taught that at the moment, but your cash flow does. Your cash flow is more predictable than your capital growth. So you have to make friends with the possibility that if you buy an asset and you see no growth or in fact a decline in value, which is entirely possible for the first few years of ownership, and you're borrowing some of the negative cash flows I've outlined in today's episode, you will end up with negative equity. And you could get yourself in a situation where that negative equity is growing and compounding. Just as positive returns compound, so do negative returns. Now, if you've got a large enough facility to see you through that, and we know that all property markets move in cycles, and if you've purchased a high quality asset from the outset, then the solution to a problem like that is just time. Just wait a little bit longer, but you've got to have the internal fortitude to ride that out. And you've got to have the risk appetite to ride that out as well. So this sort of strategy isn't for everyone. You really need to put yourself in that situation. What happens, and ask yourself, what happens in 5 years' time if our property hasn't grown and, in 5 years' time, we've got negative equity, so we owe a lot more than what the property is worth? Are we going to feel comfortable? It's not ideal. You're not going to be happy, of course. I'm not suggesting you're going to be happy, but will you be okay with continuing to pursue that investment strategy? Now, really important, what I've outlined in today's episode requires personalized taxation and credit advice before you go and implement this cash flow strategy. The loan facilities must be structured and operated correctly to preserve interest deductibility and also minimize any future challenges by the ATO. We've considered, of course, the tax rulings and the case law that relate to borrowing costs, interest capitalization, these sorts of things. And we believe that if it's implemented correctly and the borrowed funds are used solely for income producing purposes, then the strategy should work, which is not to say the strategy will work in every single circumstance. It is very much depending on how you use those facilities, how you approach it, your intention of the time. Many factors go into preserving and maximizing the tax and credit outcomes as a result of this strategy. So ultimately, it's going to depend on the investor's individual circumstances. And for that reason, really important you get personalized tax and lending advice from someone that knows what they're doing, they're appropriately experienced, but also they're appropriately licensed. So that means in terms of loan structuring, someone that has a credit license, and in particular, how you utilize those loans that are structured in that way, you need tax advice from a registered tax agent that also is familiar with this strategy as well. I don't want to overcomplicate it. I mean, I don't think it's massively complicated, but it just needs to be done right. And this strategy isn't a tax strategy. That's important to point out. It's a capital allocation strategy. It's how helping investors to allocate their capital, their investment capital, in a way that maximizes returns, particularly around internal rate of return. It does give rise to some potentially positive taxation outcomes, but they're just a consequence of the original strategy, not the reason for it. But we do want to make sure that if there are some tax benefits, we want to make sure that they're as concrete as possible. So just do yourself a favor. Don't try and wing it. Make sure you get some advice. Okay, so let me see if I can pull this all together for you. So previously, in previous episodes, I've spoken about the impact of falling property prices and rising rents in dollar terms. If that continues, and we all expect it, I think we all expect that to continue. I don't think we're sticking our neck out by saying that. But if that continues, the gross rental yield, the purchase rental yield, will continue to improve and increase because, of course, the value is coming down and the dollar value of rent is rising. Both those things are putting upward pressure on starting rental yields. And remember, your beginning rental yield is really one of the most important attributes to measure, because that dictates your cash flow. The only other thing that's going to impact your cash flow, of course, changes in expenses. Yes, they can change from year to year, but the big one is interest rates. And we know interest rates will change, but we're probably at the peak of the cycle. So if I'm able to buy a property for a gross rental yield of 5%, that's a great starting point. And maybe my interest is going to come down. So my cash flow is going to only get better the longer I hold that asset. And it means that I'm much better off buying at a 5% starting yield than a 3% starting yield. Of course, with a 3% starting yield, my cash flow expense to hold that property is much higher. So that's the first point. If gross yields, gross purchase yields get close to 5.5%, don't need to make all the way there, but 5.5%, that alone recovers the internal rate of return on an after-tax basis to where it was pre-budget night. The second observation that I made last week is if you buy before a growth cycle, your average rate over a 30-year period, instead of being 6%, it's probably uplifted by 1% to 7%. And that alone will recover your after-tax internal rate of return to what it used to be before budget night. And then the final observation, which is what I shared today, is yes, it costs more to hold a property, but if we expect that negative gearing could be reinstated down the track, or at least we give it a reasonable probability of doing so, or if we use the cash flow strategy that I've outlined in today's episode as a temporary way of managing the higher holding costs as a result of quarantining negative gearing for the initial years of ownership, again, in today's numbers, I assume doing it for 30 years, but I think that would be unnecessary in almost every single situation. Then the three things together, higher beginning purchase gross rental yields, buying into a market that is primed for a growth cycle, and then using a cash flow management strategy to further enhance and improve the internal rate of return, but also ensure that you can continue doing all the other investment activities that you want to do, including super contributions, repaying the home loan, investing in the share market, and so forth. Putting those three things together, it starts to look attractive. Now, I'm not sitting here saying that there's any urgency. I expect that prices will fall further. I expect that starting rental yields will enhance between now over the next few months. But also, we acknowledge that no one can pick the bottom of the market and no one knows how far these things will fall. And the biggest unknown is the available property on the market, and the quality thereof. So it might take me 6 to 12 months to find, the sort of quality asset that I'm looking for. That's probably going to be the variable you need to navigate, not necessarily when to, pick the bottom of the market or when to enter the market. And I'm not saying it's going to suit everyone, as I've already said. So I might leave it there today. As I said, there's a chart and some numbers in the blog. And of course, the link is in the show notes. So if you get some time, check that out. Next week, we're going to change gears. We've done enough on property. Next week, I'm going to talk about hedged versus unhedged when we're investing in international share markets. So until then, bye for now. Okay, before I wrap up, just one favour to ask. If you got something out of today's episode, the best way to support the show is to leave a rating on Apple or Spotify or wherever you're listening. A couple of ways that I can help you in return. If you want to submit a question to the show, the email is in the show note. Also, we've got 3 downloadable guides, which you can download off our website. One's a very detailed report on how to choose the best super fund. We've got a debt recycling starter guide, and we've also got a decision tool to help you navigate the tax changes. And finally, if you haven't already grabbed a copy of my new book, Wealth by Design, it's out now, and it's got a very useful AI companion tool with it. Anyway, I'll leave it there, and thanks for listening. Until next time, bye for now.